In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again to all of our Market Rebels. It's that time again, 4 p.m. Eastern Time on Thursday, and that means it is time for another edition of Coach's Corner. And today we have Scotty who's able to join us. Welcome, Scotty.
Good to be here, Bill.
Yeah, it's great having you. I know you've got a very busy schedule, but we're always lucky when you can break away and help us out here. But we always try to show traders things that they're not going to get anywhere else on the internet. Show them how to make better decisions, understand options and pricing and hedging, rolling, morphing. And today, got a very cool topic for everyone. Stu, we talked a little bit about this in Q&A the other day, but we told our people we were going to do a little more details on it. And so this is, why do options have a delta? Now you might think, well, that's obvious. Well, why is it obvious? Well, we know the definitions of delta, all right, but that doesn't tell you why it's there. And a lot of times traders who are new, they'll say, well, that just seems unfair because as the option goes up, let's say as the stock goes up $1, I control 100 shares. So why shouldn't I be gaining dollar for dollar with the stock? And it's actually a very good question. So we thought, you know what? Let's do a little presentation and show why options have a delta. And by the way, guys, check this out. My very first AI generated image. Pretty cool.
You are the coolest guy ever.
I'm not going to take any credit for it. It's that easy. So Roscoe could have done it, but it's pretty cool just how fast it can generate images like this just by describing it. So it was a lot of fun. So let's start off with our chalk talk. And this is a little thought-provoking question for everybody before we dive into the presentation. So why does an at-the-money call have a delta near 50? Now we're going to touch on in the money, at the money, and out of the money. But just let's throw out a question. Why does the at-the-money have a delta near 50? Kind of weird. So again, a lot of traders know that as a definition, but they don't understand what makes it tick. Why is it there? And that's what we're going to solve today, guys. So let's get started. And before we do, as always, please check us out, marketrebellion.com/get started. If you're looking for some good information, good articles, videos, all absolutely free information just like this to help you build a better foundation. So let's start off with a pricing model where a lot of the puzzles begin with people and bewilderment is they're going, I don't understand how this option pricing model kicks out a number. Who's to say that the option should be trading for 8? And what they don't realize is that it's actually fairly simple philosophically. It's very difficult mathematics.
Bill,
so
I always thought it was the market makers that make these prices.
No, it's the market makers that rip people off.
I hate when that happens.
So we're going to take a look at a little bit of an easier view of a pricing model. And then we're going to show you a very simple pricing model that's going to really shed light on what's going on. So let's start with a Black-Scholes model. Let's say the stock is trading for 100. We've got 365 days to expiration, interest rates of 0, volatility 20%, and it spits out an answer. It says that the $100 call should be trading for $7.97.
And just so everybody knows, the reason why Bill is using 0% is because he's focusing in on one component here. If he added an interest rate into the component, it would change all the prices. So just
it's going to, yep, you get a different forward price. Yep.
Yeah. So just to make sure that we're just focusing on what we're trying to focus on, we just take everything out of the equation and we make it 0.
Yeah. And that's a good point, because a lot of times people say, they're trying to cherry pick stuff, and because interest rates aren't 0. No, we're doing that just to block the effect, just so that we're only looking at volatility. We're going to just make it, even though it's complex, we're going to try to simplify it the best we can. So if we were to look at stock price changes, not stock prices, but their changes, up a quarter, down a half, all that kind of stuff, and we were to plot them at the end of, let's say, a time period, at the end of a quarter, end of a year, we would get a bell curve, or at least something very close. And this is the first important insight, because under a bell curve, we have probabilities. So we know that at a basic level, we've got about 68% of the data will fall within what's called one standard deviation. That's the area here in blue. About 95% will fall within 2 standard deviations. That's the blue plus gray. And then finally, almost all will fall within 3. And that's out to those wings, or out to those tails in red.
What was the most important part of that last statement there?
Almost.
Very good.
There's a 4th standard deviation, a 5th, a 6th, a 10th, but they're so small. They're not even worth talking about. But that's a good point. It doesn't mean they can't happen. In the stock market, they actually occur a lot more than they do than a standard bell curve would suggest. Those are videos for a different time. But this is what Black and Scholes chose to use to say that this is how we're going to try to value the option. Now, the volatility number that we looked at on the previous slide gives us the width of the bell curve. That's just a fancy name for the standard deviation.
Right. Just a range of stock prices.
Just a range of stock prices. So now, once we have our bell curve, we have probabilities. So let's just take a look at a very simplified version. And if we have the stock is currently at 100, that was what we assumed. Volatility was 20%. That's one standard deviation. And what that means is that at the end of the year, we should be plus or minus 20% of 100, or $20. So the upside, we would say 1 standard deviation up is 120. 2 standard deviations up would be 140. 3 would be 160, and so on. So the current stock price is always right here in the center of the curve. As that stock price moves, that bell curve shifts up and down with that stock price.
Yeah, really important, everyone. The stock is not static. The stock moves. So, and the center of this is always going to be where the stock is. So,
where the current stock price is, right. Now, interestingly, to the left of this, we're just going to use calls for this. That was what we used in the example. We don't worry about the left side of the bell curve. Why? Because the option expires worthless. So the payoff of the option is 0. Now, a lot of people say, well, wait a minute, I can lose money on an option. Well, that's after accounting for what you paid for it, but the option itself cannot have a negative payoff. Right. It's either 0 or intrinsic at expiration. So we're basically
goes in one direction. It can't land in both directions.
Right. So you're just going to have, for the puts, we would have numbers out here to the left and not on the right. But we're just going to basically eliminate or erase that left half of the bell curve. So now watch what happens. Let's do a very, and I mean very rough approximation. Let's say the stock closes somewhere between 100 and 120. In between, we would say is 110. And that means the $100 call would be worth 10.
Intrinsic.
Right? Would be $10 of intrinsic. But that's not 100% guaranteed. There's a probability associated with that. Now, we said 68% of the area is in blue, so half of that, just this right half of the curve, would be about 34%. So we can take that $10 value times the probability, and we know that that call's got to trade for at least 340. But $10 is not the only payoff of the option. There's lots of them in here, right? Tons and tons and tons of them. So let's just try another one. Let's move out to this gray between 120 and 140.
Which is another
And
way of saying the stock could be 115, 120, 125, 140. Who knows where it can be? It could be anywhere.
112.17, there's all kinds of prices that it could be. We're only worried about those above 100, right? So notice that the payoffs get bigger as we move out to the right, but the probabilities get smaller. So if we say that the stock price here is 130, $100 call would be worth 30 bucks, but this is now a lower probability. So it turns out we could do a similar trick that we did here with the blue, and we could figure out the area of this gray. And so if we take the $30 payoff times 13.5%, that's roughly the area of the gray, we come up with 405. So I said this is a super simple assumption here, or example. Let's just add those two together. What do we get there?
Looks like 745 to me.
745. What did Black-Scholes say it was worth?
Probably a little more.
797. It was almost 8, but we're not too far off. What is that? 52 cents. And we didn't hit every single possibility in here.
Yeah.
Right? We just did 2. So watch what happens if we get even fancier. So let's look at all those ranges that we talked about before, but let's split them up again. So let's look at just this, and I could split that, and I would say that right here would be a stock price of 105.
And keep in mind, everyone, these lines that Bill's drawing here, these lines under this bell curve, they are infinite number of lines. You know, as much as you want to cut them up, $1, 10 cents, 5 cents.
Keep going.
You know, it just they're infinite iterations. So think about how many combinations of payoffs you could actually add up to come up with your number. That's why Bill said it's a rough approximation.
Oh yeah. But what I'm going to show is just how good it is even by understanding a rough approximation. So here, if 110 is on this red line, 105 would be here. So that would be an option payoff of 5, but that's about a 19% chance just to the left of this red dotted line. Now, if we look to the right, in this area right here, that's going to be a payoff. If we split that, that's going to be a payoff of about 15 times a 15% chance, worth 225. If we look at this area here, let's split it. And we can say, well, what's that stock price? What is it on the left? What is it on the right? That would be $25 times about a 9% chance. Over here is going to be what? That's going to be $35, about a 4% chance.
And don't get lost in all these numbers, people. Bill's saying the stock is 125. What's the value of the option? Well, it's $25. It's intrinsic. No extras.
Yep. So we could do the same thing out here at 45. That's about a 2% chance. So we did exactly the same exercise that we did on the previous screen. We're just chopping it up even further. Now let's add all of these up. What do we get? 785. Now we're only 12 cents off.
Getting closer.
Getting closer and closer.
The more numbers we add up, the closer we're going to get to 745.
Yep, 797.
797. Yeah.
Yep, that was the price that the Black-Scholes model said. So what I'm trying to show here is that the value of an option is simply the average of the payoffs. And that's the thing that people miss. So if we looked at all of these potential payoffs, and even though there's infinitely many, let's just stick with dollars and cents down to 10 cents, 11 cents, 12 cents, stuff like that. And we looked at every single one of them and looked at the corresponding probabilities, we would come up with 797. It's just the average. But it's not real easy to see because we have to take, it's a weighted average. We're taking the probabilities, all these, and that's why people get lost with it. So to make the point and to really shed some light on what we're looking at with an option and why options have a delta, let's move to a simple pricing model. This is one I used to do in the options classes, Stu, and I think you'll like this. Let's say the stock is 100. We're also going to say that it can only rise or fall $5. Now, that's not realistic, but that's kind of giving it a sense of volatility. That's all volatility is. Yeah.
That's your range that we talked about, right?
Just a range.
Just
right? And if you
creating a range. It could be 5, 10, 20, 10, 1, whatever.
Make it, and if you say, oh, $5 isn't realistic, make it 20, make it 50. It doesn't matter. It's just a range of prices. You'll come up with exactly the same insights. Now, we're also going to assume that all stock prices are equally likely. Now, this is super a big assumption. This is definitely not the way it works in the real world. So why do we do it? Well, now we don't have to worry about probabilities and saying there's a 9% chance or a 12% chance. We're just going to say they're all equally likely. So instead of saying stock prices, maybe you could think of them as drawing from a deck of cards and each one has an option payoff. They're all, or spinning a roulette wheel. They're all equally likely. They're just different payoffs. Again, not realistic, but it doesn't matter for what we're trying to show. So keeping this in mind, let's look at our simple pricing model. The stock is 100. That's here in red. And we're always going to be looking at the $100 call. That's what we looked at before. So take a look. When we get to expiration, what is that option worth? Well, if it's 100 or below, it's worth 0. If it's 101, it's worth $1 and so on. So it could either be worth 0 or 5. Again, no negative numbers. So if this were true, if these were all of the payoffs you could expect under our assumptions, plus or minus $5, what's the option worth? Well, if we're going to make the assumption that they're all equally likely, we add up all of these numbers, all of these zeros, plus 1, 2, 3, 4, 5. We come up with 15. We divide by 11. That's just the number of rows here. And we get $1.36. That option would be worth $1.36. Now, why is that? Why is it $1.36? Well, it's the average payoff. See, if you were allowed to play this game 1,000 times, Stu, 6 out of the 11 times you're going to get 0 for a payoff, right? Let's assume there's no cost to you. You would just get 0 for 6 out of 11 times. Sometimes you're going to get 1. Sometimes you get 2 and possibly all the way up to 5. And so as you sat here over and over and over, you'd end up with a pile of money, right? You can't lose this game. We divide by the number of times and it would come up to be $1.36.
Yeah, see, this is just the average. This isn't like in our world, it's kind of like it's a weighted average.
Correct. It's a weighted average.
This is not a weighted average. This is just a straight average. And we're coming up with 136. In the real world, it weights these different outcomes.
Different probabilities. Yeah.
Gives them lower probabilities.
Yep. And that's actually another interesting point. Technically, all averages are weighted because mathematically I could say 0 times 1 over 11 plus 0 times 1 over 11. All of these are multiplied by 1 over 11. That's why they are equally weighted. So since they're equally weighted, we can just forget about them and divide them by 11. But see, you can't do that under a bell curve. That's what makes it trickier. You got to hit each one with their corresponding probabilities. And that's why people get lost. So this really sheds light that when you own an option, you have a long option you've purchased, you have a positive expected payoff. So if you're expected to win $1.36 per try, let's say, Stu, question for you, what should you be willing to pay for the option?
Well, I can tell you that I'm not going to pay over $1.36.
Okay, let's start with the obvious one. Exactly. Well, but let's talk about that. Why wouldn't you pay $2 for this?
Because the expected payout is lower than what I'm going to pay. So why am I writing a check? I'm not here to write checks.
Exactly. You're going the amount that you're spending will be far more than the amount you're winning, at least in the long run. All right. So now
on any one roll, anything could happen. But
anything could happen. And in the short run, you could beat it, but for the most part, you're just not going to.
Yeah.
Okay. In the long run. So now, what would happen, let's say, if it were trading for $2? What would you do, Scotty, if this thing is trading for $2? The average outcome is $1.36. I know you're not going to buy it.
If I was if it was trading at $2, I would bid it down. I would be selling it. Yeah,
you'd sell it. So would everybody else in the world. Everybody would figure that out, and it's going to push that price down.
Unless the buyer knew something you didn't.
Well, that's a whole different story, right? We're going to just stick with our.
That's another discussion. But, sometimes, look, I've been in situations where they come in and pay, $1, and then they pay $1.25, and then they pay $1.50, and then they pay $2. I'm selling them at $1, $1.25, $1.50, and $2, and I wind up paying $2.50 because I kind of figured like maybe they know more than me, and lo and behold, they do. Usually,
they do.
But generally, the market's efficient, but sometimes you're right.
Oh yeah, we definitely have
right. That efficiency is changing. The model's changing.
It's always efficient with the information. The market's always efficient with the information that it has to work with. right? When
Sure.
there's information that's hidden or not imputed into the market, then the numbers can be off because it's not really representing the true state of affairs.
Yep. So now let's go to the other direction. Let's say that option sellers push this down to $1 or to 50 cents to something below $1.36. What would you do?
Buy.
Now you're going to buy. If you can pay 50 cents for it over and over, but each time have an expected outcome of plus $1.36, who's going to turn that down? Well, everybody's going to figure that out. They all start rushing, make a mad dash for the gates to pay 50 cents. What happens to that price? 60, 70, 80, 90 until it goes to $1.36. So we know that's going to be the fair value of the option. And that just means in the long run, you would be expected to break even. Because you're going to.
I got a question.
Sure.
If that's the case, what you're saying is people need to pay for options. Why does everybody want to sell them to collect theta?
Let's talk about that.
Oh,
let's talk about that. And let's
I
do
didn't
the short.
really mean to go there, man. I'm kind of being funny here, but
No, but let's talk about that. What would happen if you were the short side of this? Let's say this is a put, something that people like to sell. What's your expected gain here, Stu?
the expected gain on the 136 kind, it would have to be zero. Well, it would have to be $1.36 to offset the loss that I think I'm going to get.
So
I mean,
right,
if I'm selling it, it's going to go to zero. So I got to make $1.36 in order to get my money back.
right. So the option is expected to lose $1.36.
Yeah, it's going to go to zero. I know it's going to go to zero.
Well, yes, but I'm saying that that's why you're getting paid the $1.36 up front. The expected payoffs, right, over on this side, on the plus side, are plus $1.36. If you're acting as the house, you would be paying $1.36.
Well, it would have to be, otherwise it wouldn't be trading there.
Right. So in other words, the insight here is that if you are selling puts, let's call it, and you collect $1.36, you are expected to have a negative $1.36 outcome, which means that overall you're just breaking even. So it's kind of funny when people start selling puts, they see the credit and they go, oh, that's what I'm expected to make. No, that's what you're expected to lose. That's why you're getting paid the $1.36.
Well, I think that's why they call it a liability.
It's exactly right. It's exactly opposite of what people think. All right, so let's go back on to figure out. So this is our little model. We know that the option would trade for $1.36, and we know why it would trade there. And this is exactly the same argument that Black & Scholes used. Now let's bump up the stock price $1. Still keeping with the fact that prices can only rise or fall $5, we can go down to 96 or up to 106. Now look what happens to our payoffs. We only have 5 zeros now, and we picked up a 6. See, we had 1 through 5 before. Now we've added a 6. So what's this option worth now? Add those up. It's 21 divided by 11 is $1.91. What was it on the previous screen?
I think it was $1.36.
$1.36. What's the difference between those two? 55 cents. That's why your at the monies have a delta roughly of half. Because
go ahead, sorry.
Because you've got so many zeros on the left hand, roughly 50% of these are zeros.
Okay, so let's look and see what happened here. Look, Bill, it's the same number of numbers, right? The numbers just changed. And what he
11.
did was he took everything up $1. So he dropped the 95, he added the 106. It's the same number of numbers, except now you have one more, what do you call it? Real number on the 106
One
side,
more with a positive gain. Yeah.
and one less zero.
One less zero.
Right. And now the option, look at the stock, 101. It's $100 call. Now it's in the money a little bit, right? It's
a little bit.
And check out the delta, right? It actually went up to 55.
Yep. Right.
That's
Exactly.
That's what's going on.
So we could also say
yeah, go ahead.
We could also say that we picked up 6 divided by 11 would give us 55 cents. It's just because we picked up a little bit on the very high end. All of these other numbers stayed the same, but we still have a boatload of zeros. So the thing to see, the really keen insight for an at the money option is that you've got a lot of insurance. These zeros represent insurance. Remember, you cannot lose. In other words, you cannot have a negative payoff. And so that's what you're paying for. You've got a very large insurance policy still sitting in here. So no, it's not going to move dollar for dollar. But it also is going to protect you, have a very high probability of protecting you because you are at the money. All right, so there's our at the money. So what do we know about at the monies? Well, they're going to move roughly 50 cents on the dollar. In the business, we say the delta is a half or 50 or 0.50, same thing. And the reason is that they have a heavy insurance policy. You're very likely to have that insurance policy pay off, so to speak, in the fact that you are going to have a zero payoff instead of a negative one.
Scott, I'm assuming you got a car. You got a car?
Yeah.
Do you insure your car?
Yeah.
If you total your car,
It's a mandatory cost, and it keeps going up for some reason the last couple of years, especially in the last 6 months.
I keep shopping insurance, but aside from that, if your car gets totaled, your insurance company will pay you for the car, right?
Policy gets paid out. I covers the cost of the damage or replacement of the car.
Right. And you have to pay a deductible. So what's your deductible? Whatever it is, $500, right? That's your at the money option. See, Scotty's being made whole by the insurance policy that he now has to use. He really doesn't want to use his insurance policy.
Right.
He doesn't really want to use it, but if he does use it, it's going to protect him, right? But if he does have to use it, it's because his car got smoked. And his out-of-pocket is going to be what he paid for the insurance, which is the same thing here. It's kind of a sunk cost. It is a sunk cost.
It is a sunk cost.
That's
why people think, oh, I lost on the option. Well, sort of, but what you lost on was the premium. The option has a zero payoff below the strike. So it's just that it didn't really lose. It's not a negative payoff. It's just that it didn't pay off. And you still have that cost of the premium. So that's the reason that these at-the-money options have a delta of 50. All right, let's now move up, or roughly 50. Let's go to an in-the-money option. Stock price is, let's say, 106. $100 call is worth. What do you notice different over here, Scotty, from compared to the previous two screens?
There's fewer zeros, meaning there's less iterations that are going to land out of the money.
Exactly. In fact, I've put this so far in the money that we have no zeros. So if we have no insurance policy, what is that? In the world of a call option, stock. You've got shares of stock, and what's the delta on stock?
One.
So if we have no insurance, we should come up in our simple model with a delta of 1. So let's check it out. Let's add up all of these numbers. We get 66 divided by 11 is 6. Let's bump up the stock price to 107. As Stu mentioned, we just shifted everything up by 1. So now if we add these up, we get 77 divided by 11 is 7. On the previous screen, we had 6. What's the difference now? There's your delta 1. So why are we delta 1?
I read in the chapter and under delta, right? Amount of change per $1 move.
Yeah, you could certainly say the option went up $1 for $1 change in the stock's price.
Yeah.
Yep. But because it's on every single one under our range, we're going to be delta 1. So take a look what happened, and we know that this is always going to be true because here we picked up a 12, right? On the previous screen, we only went up to 11. I picked up a 12. What did we drop off down here?
1.
Dropped off a 1. We still have, see, I've got 2 through 11 here. I've got 2 through 11 here. So what's the difference between 12 and 1?
11.
Tough question. 11, right? So if we take 11 divided by 11 is 1. And that's always going to be true. What would happen if we went to a stock price of 108? We would pick up a 13 and we would drop off a 2. And the difference is 11. Divided by 11 is still going to give us 1. We're always going to be delta 1. And that's true under the Black-Scholes model. Once you hit delta 1, provided that you keep going up or at least stay there, you're always going to be delta 1.
So, which is why, when people ask, can the option trade more than the stock? The answer is, as Bill was explaining here, no. But also keep in mind that delta 1 option or 100 in our world, it can go down. If the stock price goes down, it can go back down to
you could
zero,
eventually start falling to where we start picking up zeros down here. That's right.
Remember, it's dynamic. It's at that moment, it's a snapshot in time. It's just a picture in time, and it can change.
Absolutely.
Yeah.
So that's what happens when we go really deep in the money. We start going to delta 1. So quick reminder before we continue on, marketrebellion.com/get started. Lots of great materials there to help you
get started in trading options the right way.
So much,
All right,
so much insight here. And here's one example to use people in your everyday application. Say you have a covered call on, and the option that you're short is now 100 delta. Well, now you're making $1 on the stock and you're losing $1 on the option. So you can't make anything else.
That's why we flatten out on that risk graph.
That can go the other way. If the stock goes down, you could lose more on the overall movement of the stock than you could make on the option. It is very, very possible. And that's what we call a danger zone. And when you're in that area, when there's nothing more to make on it, you should really like cover it. Take it off, cover it with the put if you have to, if you can buy them cheap enough. But that's how that goes, right? When you can make nothing and you have potential to lose something, that's really not a good place to be.
That's right. It's not. There's no reason. There's nothing left in the option. Yep. And that's why on that risk graph, we flatten out, because at the strike of the short is where $1 gain is offset by $1 loss.
Yeah. And now here's the trap. The trap is, well, I'm going to wait till expiration so I get assigned and I just lose the stock. But while you're waiting for expiration to happen, see, Scott's shaking his head. What happened, Scott?
The value is equal to what the assignment is.
And then, Murphy's Law, what's going to happen while you're waiting 2 weeks or 3 weeks for the assignment?
Stock will reverse.
Stock's going to head south and you're going to get buried. Exactly.
Well, the insurance policy is gone. Get rid of it.
I mean, that's gamma, right? Like gamma's a change at the delta. So if you have no more gamma left, we are, as option traders, we want gamma, and it doesn't have any gamma. Your delta is now maxed out at 1.
Yep.
Common practice to roll it back down, go back to towards an 80, 85 delta.
Yep.
A long-term option.
Yep. Those are all things we like to teach for, and hopefully this pricing model, the simple one, shows you the method behind the madness there. You're saying it's because our insurance is out and we want to keep some type of a hedge on there. So with the in-the-money options, the thing to understand in there that the prices respond quickly and your deltas are going to be relatively high, certainly above 50, but most of the time, if you've got any time to expiration, 65, you might have to look super deep in the money. You might be able to find them at 100, but near expiration, you'll definitely see them at 100. But you're going to have relatively high deltas. Now, what happens if we go to the other direction? Out of the monies. I'm going to push these guys so far out. Stock is 94. We're looking at the 100 call. We can only rise or fall $5. What's the option worth now? What's the average of all these payoffs?
0.
Doesn't matter where the stock lands. You're not going to earn anything. So what's the option worth? 0. Stock rises to 95. What happens? Still
These
0.
are out of the money. That's a far out of the money chain there we're looking
Far
at.
out of the money.
Yeah.
We go to 96. Now what happens? Look way down here. We finally picked up a 1, but we've got 10 other zeros. So if we add those up, if we average them out, that's 9 cents. So think about what happened. The stock went from 94 to 95 to 96, and we picked up 9 cents. And that's why people go, this is so unfair. Why did my out of the money option not even respond? This is why. You're just sitting on a boatload of zeros. It's got to move up until you at least start showing some hint of payoffs under that bell curve.
Yeah. Or volatility expands. You got to cross your fingers that volatility expands.
Yep. And that would be the same thing as me saying, well, let's say it can go plus or minus 10 points. And we now have 102, 103, we'd have other, and we would start bringing in other values here.
See, you used to have a 50 delta option, but now the stock went down. Now you don't have a 50 delta option. Maybe you got a 10 delta option, and now the stock goes back to where it was. Well, you didn't really make your money back, did you? Right? Nope. I mean, it's back to where the stock is back to where it was, but now you might be at expiration and there's no time left, so there's no extrinsic value left. And while you were hoping it goes up and up and up and up, it actually did go up. You kind of got what you wanted, except you had the wrong product. What you really needed to do at that point was to say to yourself, I really believe in this. I still believe in the stock. It's just a different price. So let me adjust my delta from 0 back to something higher than 0 to now participate on the way back up.
Yeah, these are just not going to participate unless the stock moves and or volatility spikes. But that's why you're out of the monies. You better have a fast, aggressive move as your expectation. Otherwise, you're going to be losers. So out of the money options, your price changes are slow. Your delta is definitely going to be below 50 somewhere. So hopefully that gives you a nice little some insights, kind of shines a spotlight on the necessary mechanics to truly understand why options have a delta. It is exactly the same math under the bell curve. It's just not as complicated. So does it apply to the real world? Not in the least, but that's not important if you're just trying to say what makes it tick. And by limiting that range to a fixed number, let's say plus or minus 5, and giving it some sense of volatility without talking about standard deviations and square root pricing and stuff like that, let's just say it's plus or minus 5. And now you can see why options tend to behave the way they do, whether they're in the money, at the money, or out of the money. So back to Chalk Talk. What do y'all think? What's a good answer here? Why does an at the money call have a delta near 50? What's the really insightful answer here?
Well, Bill, let me say that was such a great explanation. I get that question from my students in classes. How are the Greeks determined? How is the option priced?
Yep.
And yeah, I mean, Black-Scholes won a Nobel Prize for that calculation.
They didn't win it
It's
for
complex.
nothing, right? Right.
And that was such a great explanation of how these probabilities determine the price of the option. It's excellent.
Well, I appreciate that. So what do y'all think? Anybody have any guesses here? Somebody
Look, I'm
ask
going to give
you.
you the easy answer. It's a 50-50 shot to go on either side of the balance.
That would be an acceptable answer, right? What I was looking,
I'm just trying to keep it simple here. It's either going to go in the money or it's going to go out
half
of the money.
zeros and half payouts under that bell curve at the halfway point.
The
You could also
probability
say
is 50-50.
There's
you
no
could also say
bias
there's-
on either side.
you could also say there's a 50% chance that we get that dollar increase. 50% of a dollar is 50 cents. But I was saying that I think the more insightful thing is that we have large insurance policies. That's what all of those zeros are for down there. They're actually to insure you. And if you have large insurance policies, you're not participating dollar for dollar on the way up. So we hope that helps everyone. I want to thank Scotty for making it here today. And hopefully you can join us next week. I don't know what your schedule's like, but we'd love to have you. For anybody else, please join us, marketrebellion.com, or give us a call. Maybe you can set up a coaching session with either Stu or Scotty.
I'd love to be here again, Bill. Yeah,
Okay,
good,
we'll do
good
it.
to be here.
We'll chat with you more. We'll try to get you on next week. And I want to thank everybody for being here. And we'll see you next Thursday, 4 p.m. Eastern, for more Coach's Corner. We'll see you then.
See ya.